Alright, welcome back. You're watching Street Smart on Bloomberg TV India. Just a quick mention on the SGX Nifty as far as that index is concerned and how it's actually panning out in morning. 0.2% cut is what we're seeing about right now. So probably indicating the fact that market after yesterday's huge rally could start off a little bit on a soft.
Co-Chief Investment Officer Birla, Sun Life AMC. Mahesh, great to have you with us. What do you make of it, Mahesh? Yesterday, fantastic run-up. Last week, consolidation. Now we're trading at all-time high levels. But the momentum in the market doesn't seem to be stopping. Ahead of elections, do you see this rally continuing?
Well, as you rightly said, I mean, the expectations, which have built up in run-up to the elections. And mind you, I think India market, if you look at after the last couple of years, we have seen a slowdown. And a lot of the macroeconomic factors which were negative, at the margin there is some positivity around those numbers. And even in a global context, I think compared to the other emerging markets, I think India looks relatively better. And that's the reason why we have seen, despite negative news globally and outflows from the emerging markets, Indian markets have done reasonably better. And as I said, election is a big event. There is a lot of hope around that, and whether that could turn around the economy, I think, is the key thing which the market is looking forward.
But after the kind of run-up that we've seen, most of these sectors, most of these stocks, they've run up massively in the last, one to 2 month period in this entire pre-election rally, which you're talking about. You think probably it's now time to just turn a little cautious, calm down a little bit, probably take a little bit of more of a longer-term call and probably play the defenses? Should investors be looking at that from now?
Yeah, I think, as rightly said, there's been some sector rotation, what we have seen. The cyclicals, which had been lagging. So there is some catch-up happening over there, though it's more determined in terms of the future outlook rather than any change in the underlying fundamentals at this point in time. So I think that sector rotation will continue. I think the run-up, what we have seen in some of the cyclicals, could probably, because it's still dependent on an event. While we still believe that from a medium and long-term perspective, cyclical sectors will do well because they're at the bottom of the cycle. As the economy recovers, they should outperform.
I think the larger question here is also in fundamentals. As you just said, it's all really about the economy, and we've got those growth concerns that are persistent. We've got the RBI meeting, of course, next week. Are you really hopeful we'll see anything come out of that in terms of a rate cut at this point? Even if that does happen, that's only one small part of it. It's going to take a while, isn't it?
Yeah, so we're not really looking at any rate cuts in the immediate term, but as I said, we have hit a low in terms of economic downturn, and at the margin there are things which are happening, which could lead to a slight recovery. We're not expecting any dramatic turnaround next year, but clearly from what we saw this year, I think next year should be at least 50 basis higher in terms of GDP growth. But having said that, even the defensive is also where there is good visibility, and early I think those sectors also look good, like IT, for example, and pharma. We're still positive on those names, though the recent run-up, they have underperformed a bit.
Okay.
Yeah.
So I just want to address the pre-open, especially the oil and gas stocks itself. You can see the benchmark indices seeing a little bit of a cut in terms of what we're seeing right now. 130-point cut coming in on the Nifty. The Sensex also trading tad bit low, but it's the oil and gas pack. They're 3.5 on Reliance Industries. Pull up ONGC for you as well. 2% cut coming in is what we're seeing. This is going to be one space to watch out for. You want to keep an eye on Oil India as well. That's the other one that actually takes a hit. So some of the other ones, the GAIL, IGL, actually could stand to see a little bit of a gain from this. Power and fertilizer also, remember, will be another space in focus on the fact that the gas price now getting somewhat deferred to a certain extent. But well, it's all eyes as far as the big losers are concerned out here in terms of ONGC and Reliance Industries, at least on the sentiment bit. The fact that it's being deferred, not rolled back, but still it's being deferred. And remember, analysts were actually building in a lot when we talk about that event itself for these two counters specifically. Quick mention of the currency, hovering around 60.57. I don't know, pretty flat so far.
Actually strengthening. It's very rare, Priyank, that I have good news when you have bad news on the equity markets, but I do have good news this morning. We're moving towards 60.58, which dealers are telling us is a very important mark to watch, because that's when they're expecting a lot of the importer demand to come in as well. The RBI is expected at some point to come and start shoring up forex reserves as well. Bhaskar Panda on the phone with us this morning. Good morning, Bhaskar. Surprised by this currency strength, and how far do you think it can go ahead of especially the policy next week?
Good morning. I think the strength is on the basis of flows that is continuing into India. Obviously, we should remember that Russia has been going through a kind of sanction from US and other Western countries. So obviously, I hope we should be beneficiary of that negative news, and the money is still pouring into India. Secondly, I think everybody is believing that there would be a stable government coming in after the elections. Therefore, people have put their belief in their purses and to put that money on the stocks and so on and so forth. If that continues, I see rupee going towards maybe 60-20, 60-30 in the near future, and if it breaks, then probably we can look at something. But I'm still doubtful that it can sustain at a very lower level as of now.
All right, thanks.
Given the systemic challenge that we have as of today.
All right, Bhaskar, thanks for that. That's the view coming in from HDFC Bank. It's interesting, nobody has changed the year-end targets for the rupee. Nobody expects the rupee to actually go ahead and end the year at about 60 or 61. The consensus call on Bloomberg still at about 63.
Although there are some people who are expecting magic once Modi comes in. Thanks for that, Anu. Let's just get back to, the sector allocation, as you were talking about. You said, for example, defenses, don't rule them out yet completely. If you had to actually, create an ideal basket at this point of time, how would you weigh up cyclicals versus defensives? And I know that there are, of course, specific stocks here that you must be looking at, but just for a broader perspective, what are you advising investors right now?
Well, what we've been saying is that, there is some shift, in the last 2-3 years, we've seen defense things doing well, and we've seen a valuation expansion over there. As we see a broader recovery in the economy in the next 2 to 3 years, cyclicals is where. And within the cyclicals, again, banking and financials is somewhere we are more positive, especially the private sector banks. And typically, this is a sector which leads in the initial part of the market recovery. So that's one sector in the cyclical side where we'll be over it. In the capital goods sector, companies, where with good balance sheet and strong names are where again we are recommending to be over it, because I think companies where there are balance sheet issues, there's still a lot of time because interest rates are still pretty high. So these are two sectors clearly over it, and obviously media has been a more secular long-term sector which we think will also benefit from a cyclical recovery in terms of ad spends going up. And in the defenses, we'll still say be neutral on IT and pharma. FMCG is a sector where we would clearly be underweight and taking that weight for some of our other overweights, because there I think the valuations and the slowdown what we're seeing, clearly the risk reward is not favorable this point in time.
What about the oil and gas pack? I mean, Mahesh, that clearly is the one in focus today on the back of that surprise move coming in from the EC. I just want to pull up the stocks for you once again, just get a quick update, because a couple of these ones in the pre-open at least are showing a little bit of weakness. You got ONGC trading a little bit lower, Oil India those actually just spiked up a little bit, but ONGC down 2.8, Reliance Industries, to what I last checked also, was seeing a little bit of weakness is what we'd seen. Just pull up Reliance Industries for you there, 2.5% cut. But on a broader scale, Mahesh, were you surprised with this move, and what does this actually mean for the industry?
Well, in the oil and gas sector, we have seen some kind of flip-flops. Initially, even from the government policy environment, we have seen price hikes, which were supposed to happen, didn't really happen. But I think more recently, we have seen, especially a diesel price hike that has continued, despite there were concerns that going into election, where there will be rollback. That's a good positive. I think the broader changes are happening in the right direction. These kind of setbacks, in price hike also, there was some confusion. Whether there's a PR also which is there.
True.
So there was some uncertainty around that. I think it's just a deferment. I think it will eventually, it should eventually take place. So I think in the interim, I think this sector has seen a lot of volatility because of these changes, either from the government side or some decisions not really coming through. But I think fundamentally, I think we have seen a re-rating in this sector, especially the oil PSU names, and that's primarily based on the premise that you will see improved balance sheets, as some of the subsidy burden gets lowered, and that should be good from a medium to long-term perspective for the sector.
I know you said you're underweight on FMCG at the moment, but I just want to get a sense, with monsoons around the corner, and there's always some build-up ahead of that when it comes to some of these consumer-oriented stocks. Even, for example, two-wheeler counters are suddenly seeing some amount of buying coming in. Just even if it's for seasonal factors, but would you perhaps be taking another look at them closer to the time?
Well, I think consumer stocks, I see again last 2-3 years we've seen the rural side of the economy doing pretty well because of the policies of the government. Even MSP prices were pretty high. That to some extent has moderated down, and we've seen some slowdown on the rural demand, which was driving some of the demand for all these consumer names. So I don't, that's going to really come up significantly. Again, monsoons also going forward next year, there's this El Nino effect which is being talked about. So one doesn't know how that will impact. But with concerns around that, because last year was a decent, good monsoon on that base, whether we would be showing a higher growth, something which is still not clear.
Right.
So until clarity emerges there, I don't see any significant drivers for some of these firms.
The other interesting bit has been the metals pack, Mahesh, and this one's really been interesting because you got that huge rally coming in the last 3 to 4 months, a little bit of correction as China's concerns started to emerge once again. But in the last couple of weeks, they were again starting to show some kind of traction. Are you looking at this space right now, or it's too volatile?
Well, metals, as you rightly said, we had seen good interest because the stocks were beaten down, the valuations were attractive, and mind, a lot of Indian companies had created capacity in the last 2 years. And these are still not productive, and that should contribute to growth coming in the next couple of years. And we are seeing rupee depreciation also benefiting in terms of realizations. Sure. To that extent, that initial run-up what we saw in the commodity space has been done, but as you rightly said, some concerns coming in China and slowdown, and how will that impact. But I think for Indian companies, it's more important, a lot of capital WIP is stuck in projects, whether it is Hindalco or some of the other names. And as that starts contributing, because of some clearances coming through, that could drive volume growth going forward. While the domestic demand is weak, but they can still cater to the global market. Like we've seen steel, we started exporting now compared to imports last year. So I think by and large the sector looks fairly priced, I would say, and valuation is still reasonable, and any kind of uptick on the domestic side in some of the clearances can lead to value creation going forward.
Right, so very quickly then, 2 trigger points the markets are actually watching out at this juncture right now, which investors need to be cautious of.
Well, I think one is that there's some expectations which has been clearly built up in some of the stocks, and especially in some of these smaller names we have seen a huge amount of action because there's not enough amount of liquidity which is around. So one should not really get too much carried away. I think stick to the fundamentals, and clearly election is one big event. I think one should not really speculate too much. Look at where we are. Our belief is that despite the elections, there could be some volatility pre-election and post-election, but we are at a phase where we are at the bottom of the cycle, and the risk on the upside is more than on the downside. That's one way to look at it.
Maintain caution.
Yes.
Thanks so much for joining us, Mahesh. Have a great day ahead.
Thank you.
All right. Let's take a very quick break. On that note, we'll come back with more market talk. Just stay with us. We'll be back in just a minute.